Right now, I'm gonna be going back to chapter 1 and solving some of the assignments or some of the questions that some of you are having some difficulties in. Some of you were finding number 6 a little bit difficult, and I would like to go through it. Which of the following statement is correct concerning the organization structure of a corporation? Now, here we are looking at the certain organizational structure. So the first thing you want to do is to go back to your lecture notes and look at how the organization structure. If you go there, and you will remember that there is a certain structure which I'm just gonna refer to it here. We have the board of directors. All right, and then afterwards, what we have the CEO, which is the chairman of the board and the chief executive officer. And then afterwards, it goes the COO, which stands for the chief operations officer. Okay, and then after that, we have the vice president of finance, or also known as the chief financial officer, so CFO. Okay, so as you can see, each one of these will report to the one above him. So let's go back to look at these, multiple choice questions. So the first thing is telling you that we have the vice president of finance reports to the chairperson of the board. Well, this is not true, because we know that the finance president of finance, which is the CFO, report to the CEO, not to the CEO. Okay, the second one is the COO report to the CEO, and this is apparently true, as you can see in your organization. So it's actually number B. The controller reports to the president. That doesn't really make any sense, because if you look at the chart again, you will see that both the controller and the treasurer are under the CFO, and therefore they have to report to the CFO, not directly to the CEO. The same holds for the treasurer. The treasurer should report to the CEO, not to the CFO, not to the CEO. All right, so let's go to another question that is also of some relevance important, which is number 7. The key differences between the responsibilities of the controller and those of the treasurer is best defined as a separation of duties between what? So I just want to go, before going into these details, I just want to remind you of what we, remind you of the organization structure again. And remember that both the treasurer and the controller, they both report to the chief financial officer, which is the CFO. The treasurer is responsible for handling cash flow, managing capital expenditure decisions, and making financial plans. While the controller, on the other hand, handles the accounting function, which includes taxes, cost and financial accounting, and also information system. So, talking about the first option, which is managing assets versus managing debt and equity. So when it comes to managing assets, we already have spoken about that this is by the, in the financial accounting, and this is usually done by the controller. Obviously this includes managing debt and equity. Both things are being done by, in financial accounting, which is, done by the controller. And therefore, there is no separation here between the controller and the treasurer. Processing tax records versus accounting records. Now remember, if you go back to your book, you will see that when we talk about controller, the controller is the person who handles accounting functions, which is accounting records. He also manage the taxes. He also accounts for the taxes and manages the taxes, and therefore he is the one who processes the taxes. And this is also some of the characteristics of the controller. Now the third option is when we talk about national versus international operation. This has nothing to do with the differences between either of them. So if a company has, you know, international operations that is occurring outside the country, this doesn't mean that one of those he's gonna be controlling for that, while the other is not gonna do anything with it. Both of them in this kind of organization, they both have to work hand in hand, and this doesn't mean that they are separated between national and international. Well, by definition, we know that the controller and the treasurer, none of them like have, to do the marketing while the other has to do the production. This is not true. So all of what we have just discussed is not exactly true, doesn't fit the differences. So it's definitely part E, right? So cash controller versus accounting records. And this would be our answer to this question. The cash controller is being done by the treasurer, because he is the one who is responsible for handling cash flows. Okay, while accounting records is usually done by the controller, because he is the person who is responsible about the financial accounting. Okay, so now we go to question number 9. Which one of these is a corporate document that sets forth the intended life of a firm? Now, remember, when we say about a corporate document, it's just a document that is being, issued by the corporation. Remember that starting a corporation is much more complicated than starting a partnership or a sole trader or a sole business. And the incorporators must prepare articles of incorporation. And remember that articles of operation is also referred to the charter or corporate charter. Okay? And this is a written document filled by the US state, by the founders of the corporation, detailing the major components of a company, such as its objectives, its structure, and its planned operation. Okay? And this includes the name of the corporation, intended life of the corporation, business purpose. So all of those kind of details that are issued by the articles of incorporation. So I just want you to remember this from your slides and from Mr. Thomas. Now, so it's definitely not federal charter, because we are talking about corporation charter, which is a synonym of article of incorporation. It definitely has nothing to do with corporate bylaws. Remember that the bylaws are rules to be used by the corporations to regulate its own existence. And this has nothing to do with setting forth the intended life of the firm. So it's not C. And so, it's not gonna be any of the rest. It's gonna be B. Now going to question number 14, the articles of incorporation. The first option says can be used to remove management from the company. Now remember, if you go to your textbooks, you will see there is something called set bylaws, and and the articles of incorporation. When we talk about the articles of incorporation, you will see that among them is the number of shares of stocks that the corporation is authorized to issue. With a statement of limitations and rights of different classes of shares. So if you just review your textbook, you will remember that it's definitely going to be number C, which is set forth the number of shares of stocks that can be issued. So it's going to be C. It's not going to be A, which can be used to remove management from the company. It's not going to be B, which are amended annually on the company's stockholders. It's not going to be D, which sets forth the rules by which the corporation regulates its existence. And it's not going to be E, which can set forth the conditions under which the firms can avoid double taxation. It's none of those. Those are for different corporate documents. So the other question that we would like also to answer is number 25. A proxy fight occurs whenever. So let's remind ourselves what we mean by proxy fight. Remember that when we are talking about, the mechanism, when, we have some stockholders that are unhappy or not so happy with the existing management, when this occurs, we have something that is called proxy fight. A proxy is the authority to vote someone's else stock. So a proxy fights develop when a groups of group solicits proxies in order to replace the existing board and thereby replace the existing management. So having set this definition of proxy fights, where does it occur? So whenever any board member is up for re-election, this is not true. A firm flies for bankruptcy. This is not true as well. The shareholder sells shares in an open market. This is definitely not the case. A group solicits votes to replace the current board of directors. This is the answers, which is part D. And a firm is declared insolvent. This is never, it's not related to what the definition of a proxy fight is. Alright, so let's go now to the second part of our chapter 2, which is the multiple choice questions of chapter 2. And we're going to start with 1 because it is very important for our midterm. The long-term debt of a firm's, so long-term is something that is at least 12 months, cannot be lower than that. Long-term debts are the firms of a firm are liabilities owed to the firm's stockholders, definitely not owed. So it's not A. That do not come due from for at least 12 months. Yes, this represents some long-term information, and definitely this would be an option. The third, owed to the firm's supplier. This is not true because long-term. This is not true because obviously we have to pay the suppliers money. We cannot take money from them or lend from them, borrow from them, and therefore we cannot consider this as an option. That comes due within the next 12 months. This is not true because we need at least 12 months so to be considered long-term debt, and this is not true. This is a very short term debts, and the firms expect to incur within the next 12 months. This is also not true. Okay, so now going to the other question that we will also like to solve in this tutorial is question 4. When making financial decisions related to assets, so we are making some financial decisions and they are related to the assets, you should option A is primarily place primary emphasis on historical costs. This is not true because the prices goes up and down. So if it was historically up, that doesn't mean that it's gonna stay up. And therefore, if we really need to have a very smart financial decision, we cannot only simply look at the historical cost. Place more emphasis on the book value than the market values. Well, basically, this is not true. If it was a financial decision, if it was non-financial decision, that this might be the case. Rely primarily on values of assets as shown on the balance sheet. That's not true because we cannot. When we are making financial decision, we cannot only look at the value of assets that are on the balance sheet because they could have recorded previously and therefore considered historical costs. Always consider market values. Yes, that's actually always the option. So instantaneously, at a particular point in time, we only look at the current value and how much it's really worth to do this financial decision in order to make some profit out of your decisions. Only consider market values if they are less than the book values. Well, that's not true. It's gonna be number D. Alright, so let's go to the other question, which is question number 8. What deductible, residual, marginal, average, or total tax rate is a percentage. So when we talk about percentage of the next taxable dollar of income you earn. So basically when you earn, let's say D dollars, okay, this amount is the tax rate is a percentage. So the tax rate is a percentage, which is a certain percent of your, of your dollar of income you earn that is payable as tax, and this is known as, by definition, as a marginal. So this is considered marginal tax rate. Okay, so let's go to another question on taxes. Number 9. Your tax rate measures the total taxes you pay. So it's, let's say, the total tax, TT, total tax, divided by your total taxable income. So the total taxable income. And this is considered to be an average, because you can see that this is a certain mark on a certain bigger mark, so it's definitely going to be considered as an average, not a marginal. Okay, and you can see these are the total. It's never considered to be total tax rate. It's going to be deductible, no. Residual, also not. Alright, so let's go to another important question that a lot of you were also questioning. Question number 12. The cash flow to creditors increases when. Remember what we mean by creditors is the entity that we are borrowing from, like the banks and so on. So cash is used to reduce accounts payable. This is not the case. Okay. Here we have to remember what we mean by accounts payable. An accounts payable is an accounting entity that represents a company's obligation to pay off a short-term debt to its creditors or suppliers, and therefore we cannot say that this is a cash flow to creditors increase when cash is used to reduce accounts payable, because it increases accounts payable to increase the cash flow to creditors. New shares of stocks. The other option, which is option B, new shares of stocks are sold for cash. Now, when we talk about new shares of stocks are sold for cash, that doesn't mean that this generated cash, is gonna be helpful for the creditors, and therefore it doesn't mean that the creditors are gonna be increase, and therefore it's not gonna be option B. Interest is paid on outstanding debt. Yes, that's true, because if we are paying interest to the debt, this means that we are paying additional money to the banks, which are the creditors, and therefore it's gonna be C. An asset is sold for cash. That doesn't help anything. It doesn't answer anything. It's only that we're having some cash, and this cash is definitely not gonna be added on for the cash flows of the creditors. The last option is a long-term debt is incurred. Well, when we have a long-term debt that is incurred, so a long-term debt is incurred, this means that I'm borrowing some money from the creditors, and therefore it's cash flow from the creditors, not to the creditors. So let's go with the other question, which is question number 14. The cash flow of a firm, is also referred to as a cash flow from assets. Okay, so the cash flow from assets, which must be equal to the cash flow to debt holders minus cash flow to equity holders. That's not true, because this doesn't resemble the cash flow from assets. Equity holders plus the cash flow to debt holders. Yes, because when we are talking about equity holders plus cash flow to debt holders, this means that this represents the whole company in a way or another. It could be the equities and the equity holders and the debt holders, the two parties of the company who are financing the company. The government plus the cash flow to equity holders, the government has nothing to do with this, and therefore it's not a government. Only if paying taxes, but this has nothing related to that. Equity holders minus the cash flow to debt holders. So this has nothing to do with this as well, because equity holders minus the cash flow to debt holders doesn't resemble anything about the cash flow from assets. So it's definitely should be a plus rather than a minus. The government, the debt holder, anything that has to do with the government is definitely not the case, so it's gonna be part option B. So now let's move to another question that a lot of you are finding it difficult. A firm has a total equity of $2011. Net working capital is given by $175, and the long-term debt is given by $890, and current liabilities is of $420. What is the amount of net fixed assets? So remember the formula of net fixed assets. The net fixed assets is given by long-term debt plus total equity minus net working capital. So if you do this, you will find out that this is, long-term debt is equal to 890 plus total equity, which is 2011. And then you have minus the net working capital, which is 175. And it has nothing to do with current liabilities. And this would be equal to 2,726, which is C. So now let's go to question number 16. Martha's Enterprise spent $3,300 to purchase equipment 2 years ago. So this was a historical price. This equipment is currently valued as $2,357 on today's balance sheet, but could actually be sold for $2,750. So this is a market value. Net working capital is given by $860, and the long-term debt is given by $1,650. Assuming this equipment is the firm's only fixed assets, what is the book value of the shareholders' equity? So we are talking about the book value of the shareholders' equity. Okay, so remember, when we talk about book value of shareholder equity, we are referring to it's also known as a shareholder's equity. And since we are talking at book value, we should definitely consider the equipment at its book value, which is 2,357. So this is 2,357 plus the net working capital. So the net working capital, because this resembles the assets, total assets, which is 860 in our case, minus total liabilities, which in our case is the total long-term debt, and this would be $1,650. And calculating this amount will give you, which is equal to 1,567, which is C. Alright, so let's go to question number 17 now. Assume sales are $1,100 cost of goods. So this is the sales, which is the revenue. Okay, so revenue. The cost of the goods sold is 500. So this is the cost of the good, which is 550. So I'm going to write the numbers below these numbers, below these letters. So we have 1,100. And then the depreciation expense is $80. So we have to remove from it the depreciation. And the interest paid, which is $40, and we have to remove from this price $40 paid as interest. Selling and general expenses are $230, so we also have to remove the $230. Dividend paid is $45, but when we talk about $45, we should be careful about this, because we cannot remove this right now. We have to remove it later on if we are concerned with, if you continue the question, retained earnings. So I'm not going to remove the $45 here because the dividends cannot be deductible by the tax rate. So, and then there is a tax rate. So we want to talk about the disposable income, or basically what we call as a disposable kind of profit, which is 0.34, not disposable. It's not called this. This is for disposable income. But I want to say that this is amount of profit generated after tax is being taken out of it. So it's gonna be 1 minus 0.34. Okay. Now that we have done this kind of calculation, the amount of money, this thing will generate you some money. Now to talk about the retained earnings will be what is gonna be going back to the company. And therefore, if we want to know what is the retained earning, we have to remove the dividends. So we have to remove the $45. If you do the calculation, it's going to be 113.4, which is going to be part B. Okay, so now let's go to question number 18. In question number 18, the tax rates are shown. Remember that this is somehow very similar to the marginal tax. And you can see that if you earn somewhere between $0 and $50,000, this means that you are only going to be paying for such kind of income, you're going to be paying 15% of this. So if you are earning at least 50,000 pounds, you're going to pay this amount of money times $50,000. So 0.15 times $50,000 is, if you, let's say you're earning $50,000, you're going to be paying this amount as tax. Now let's talk about adding into if you are earning in this kind of question, they are saying that this person currently has a taxable income of $163,000. What is the firm average tax rate? So this means that if we are paying so this $163,000 is among this bracket. So we have to go from 1 to 1 for each and every tax rate. So 0.15 times $50,000 plus you have additional here the difference between $75,000 and $50,000, which is $25,000. But we have to multiply by 0.25 because this is a tax rate. Then we have to add to it the $0.34, which times also $25,000 because this is 100 minus 75, which is $25,000, plus 0.39, which is talking about this tax rate, multiplied by the difference between this amount of money, which is the one your current salary, minus the 100,000 pounds. 100,001 is fine, which is $100,000. And after you calculate this, you have to divide all your answer by $163,000 for $100, and this will give you your average tax rate. So if you do this, you will find out your average tax. It will turn out to be 28.75%, and this would be C.